address what is tax planning. Then we'll talk a little bit about salary versus dividend and income splitting before we wrap up by looking at the different investment vehicles, RRSP, TFSA, RESP, RDSP, corp and unregistered, and the pros and cons of using each and how they impact your tax planning. The reason we're putting this webinar on now is we do recognize that a lot of people are planning to make RRSP contributions by the deadline of February 28th, and people may want to be aware of what the implications of that are. So let's kick off without further ado and tell you a little bit about who we are. We are a firm of chartered professional accounting firms, founded in 1984 by my father, George Wall, and later merged together with my own practice to become Chartered Professional Accountants for Information Technologists, which is a top 50 cloud accounting firm. We've won that designation 4 years in a row. We're also a member of the National Association of Computer Consulting Businesses. So we're speaking regularly with recruiters and people from the industry and aware of all the issues that are specific to this niche in this field because we've been specializing in it, like I said, since 1984. We're also one of the few ISO registered firms, which basically means that we have systems and processes, and that those systems and processes are audited by external auditors who come in to make sure that we're following those systems and processes, and also that we're constantly striving for constant and never-ending improvement, which is a big mantra around here. So ultimately, why do independent contractors and small business owners choose to work with us? Well, we do offer a free initial consultation, although that's becoming almost industry standard. One of the three key ones that I think really people choose our firm is the turnkey solution. Because we offer an in-house paralegal, we can assist with setting up the business, winding down the business. We do also have relationships with financial advisors, lawyers, all the people that you need to have on your team as a professional financial team. We also do industry benchmarking to show you how you compare your average, compare your financial information against the average and the median, pinpointing risks where you're above the average and potentially red flagged not only by us but by CRA, and also benefits or opportunities where you might be below the average and there's a potential benefit for identifying more expenses that you might not be aware of that you can deduct. Lastly, we have our audit representation protection, which means that if you have this, that you are represented up until the third and final stages of appeals at no additional cost. The cost for the audit representation protection is $300 unless you are on a prepayment plan. So for those clients who are on the call and not on a prepayment plan, save yourself $300, get that audit protection completely free of charge. It's a great value at $300, but when you can get it completely free of charge, it's a no-brainer. And having someone in your corner who's knowledgeable, understands the issues, is really essential to help you maximizing and keeping those deductions that you're legitimately entitled to. So let's talk a little bit about what tax planning is. Got a little definition as taken from Investopedia, sort of like the Wikipedia of investments. It says tax planning is the analysis of a financial situation or plan from a tax perspective. The purpose of tax planning is to ensure tax efficiency. Reduction of tax liability and maximizing the ability to contribute to retirement plans are crucial for success. So as our clients who are on the call know, we are taking a holistic plan. We're not just looking at the corporation. We look at your whole plan. We do a personal net worth assessment and help you figure out a strategic goal for retirement and what that means as far as target savings to achieve that goal. So one of the big things that makes a big impact on this is our tax planning. And the key with tax planning is being proactive. It's very hard to do planning reactively. Once things have happened, we have very limited options available to us, whereas when we can plan out for the future, the more future forecasting that we can do in future planning, the more effective our tax planning and tax strategies can be. One of the most important things to know and understand about tax planning is a lot of it revolves around the income tax brackets. In Canada, we have a marginal tax system, which means that you pay a certain tax rate on one level of income, and as the income goes above that level, you pay a higher tax rate, but only a higher tax rate on that income above that level. Now, I'm showing you the Ontario harmonized tax rates, and this is giving you the other income, which is typical small business income, capital gains, eligible and non-eligible, personal income tax rates, capital gains, which is effectively half of the personal tax rate, and Canadian dividends. Eligible are for dividends from corporations not getting the small business deduction. Non-eligible are the rates for small business dividends from companies who are eligible for the small business deduction. Because they're paying a lower tax, they get a lower dividend tax credit, and so their effective tax rate is higher. We're going to talk more about these different tax rates as we work through our planning. There are a lot of different brackets here because it is combining the federal and the provincial. Generally speaking, there's a couple of key ones that we look at. The $47,000 tax break is one. There is a basic exemption level too as well that we factor in that isn't listed here, which is in around the $12,000 mark. $95,000 is another tax bracket break, then $150,000, and then anything over $220,000. So those are the major tax brackets that we tend to focus on, but this breaks down all the individual tax brackets, and we will make this slide deck available for anyone who is interested in having it. So when we're looking at how to optimize tax planning, we want to use as many tools as are available. Potentially dividends have a factor, and we're going to talk specifically, as I mentioned before, about the difference between dividends and salary. We want to do what we can to smooth income. So what I mean by that is we don't want to have 1 year of $100,000 of personal income and another year of $20,000. We'd rather have 2 years of $60,000. Smoothing income, again, just like income splitting, is based on the principle, because we have a marginal tax system, that 1 year of $100,000 would probably be somewhere in the neighborhood of about $4,000 more in tax than 2 years of $50,000. So the ability to smooth income like that is really going to make a substantial difference in the amount of tax that you can pay. So we can use a number of different strategies to help smooth that income. Obviously, one of those strategies is leaving money inside the corporation and taking advantage of the small business deduction limit. So the small business deduction, you pay a much lower tax rate on income inside your corporation than you do personally. In Ontario, you've got up to $500,000 of small business income that's only taxed at 12.5%. That is different than the investment income, and we will talk about that when we talk about the different forms of investing. And then you've also got strategies like tax-free loans. So you can imagine if you want to take a big chunk of money out to buy a car or to purchase a home, that would cause these spikes and avoid the ability to smooth income. But we've got tools like tax-free loans that we can use to do that. So if you're considering buying a house, you're considering buying a car, making any large life purchase, I strongly encourage you to reach out and connect with your account manager and figure out the best way to manage that. Again, the more proactive that we can be on these major life purchases, the more effective that we can be in your tax planning. Now, I do want to jump into a little bit about salary versus dividend, because this is one of the most common questions that I get asked. Which is better for me, salary or dividend? This is somewhat of a subjective decision. There are pros and cons of each. The benefits of a salary is that it's not going to be subject to the tax on split income rules, or TOSI. We will be talking about that more as we get into some more information on the different forms of organization. It is eligible for CPP, which we do consider to be a positive thing, and it is eligible for RRSP. Again, we consider that to be a positive thing. CPP and RRSP are subjective. RRSPs, some people don't like them. There's lots of reasons that they don't like them. We think tax deferral is a good thing, and that's one of the big things that RRSPs bring is tax deferral. And again, we'll be talking about that more as we get into RRSPs. And CPP, which is Canada Pension Plan, well, it's not your best investment vehicle. It is a guaranteed return in retirement, which is why we do tend to like that. But because you're eligible for CPP, that means you're paying into it, both the employer and the employee side, which is why you get better cash flow with the dividends, because you're not actually paying out the CPP. Currently, you won't pay out anything other than the personal tax on the dividends that you receive. There's a little bit more greater flexibility with dividends. That is changing now because of the new changes to the TFSA rules, the tax on split income. Prior to the changing in rules, you could do complete free reign on splitting income through the use of dividends. That has changed now. We'll talk a little bit more about how that's changed and what implications there are as we get more into those sections. Now, one of the things that I've got up here is I've broken down just the non-eligible small business or dividend tax rates, and also added in the small biz tax rate to give you a direct comparison and to show you that the actual difference in tax is very, very small. I think the largest difference is 6%, and that's over $220,000. So the way dividends are taxed it's quite complex. There's a dividend gross up and a dividend tax credit. So it gets a little bit more complicated. What I can tell you is the theory of integration is intended to make there be zero to a very small amount of tax consequences of choosing one form over another, salary versus dividend. Now, where you would want to consider using a dividend over a salary is looking at other factors other than the actual tax. So again, you might want to look at, whether you want or feel there's a benefit to paying into CPP or RRSPs. Plus, the other thing that you might want to consider is what type of what's going on with your corporation. Does it have positive income that you want to reduce? And if you're trying to reduce your small business income, then a salary does reduce the taxable income. And because you haven't paid any tax on that salary, because it's an expense to the corporation, the individual does pay the full personal tax rate. The reason the dividends get a lower tax rate is because those dividends come out of money, or what are called retained earnings, money that's already been taxed, which is why when we go back to the schedule, the tax rate here says the non-eligible tax rate is only 8.89%. When you add in the small business tax, it's actually 21.39%, slightly higher, not substantially lower. So you have to take into account the other tax, which is the corporate tax that's going into it. Now, there is a dividend tax credit as well. So like I say, paying dividends certainly gets a little bit more complex. And I would certainly encourage anyone who's trying to make the decision between salary versus dividend to, again, have a conversation with their account manager to figure out what's right for them. But the high level is, if your account manager isn't going to you and saying, look, salary is a bad idea because you don't have the income to support it. Like, you can imagine in a situation where you have zero income in the corporation and you have a salary, you would create a loss. And if you can't carry that loss back to income that was earned in the prior 3 years, then it's only going to carry forward and only be available to use if you ever have income in the future. So in a situation where, let's say that you have built up a lot of money inside your corporation, but you've gone back to a full-time role and or you've retired, then at that point you're probably going to want to switch to a dividend instead of a salary, because having an expense, a salary, with no income will create a loss, which you may or may not be able to use. So that's some of the reasons that you want to do that. Again, in the past, we used to use dividends more for income splitting with family members who weren't involved in the business, but unfortunately the new TFSA rules have really completely taken that off the table, unfortunately. Now, that doesn't mean we can't do income splitting. There are some income splitting opportunities available to us. They really do benefit the higher earners. So if you've got individual wages, greater than $90,000, it's going to be a benefit for you, unless your partner or your children have other income. Because the purpose of income splitting is to make use of the other individual's basic exemptions and lower tax rates. The salary, if we're doing income splitting through the use of a salary, is subject to a reasonableness test, which means that we have to pay them a salary that's reasonable for the work that's being performed. And we need to also have flow of money. So if we're paying children in particular, we need to see a check written, paid to the children, cashed. If they want to gift that money back to you or pay you some rent, whatever the case might be, that is fine, but we do need to see the flow of money going out from the corp to the children. If you're doing income splitting with your wife, the flow of money isn't as critical because they somewhat do consider you the similar entity. You probably have joint accounts. But what does become important to have as far as documentation down the road are things like job descriptions, invoices, those types of things. So the more documentation that you can wrap around this, the better off that you will be. Now, that being said, it also comes down to the amount of money that you're doing income splitting with. If you're doing smaller amounts, obviously lower risk, lower level of documentation. If you're going to be more aggressive, you really want to make sure that you've got that documentation in place. So if you are going to do income splitting through the use of dividends, you do need to be aware of the new tax on split income rules. Previously, these rules only applied to people under 18, and basically any income that was taxed under those rules was subject to the highest personal marginal tax rates, eliminating any advantage that you might have gained by doing any income splitting. And the new rules have basically come into place to affect people over the age of 18. So this was often referred to as the kiddie tax prior to this, and now it's gone well beyond children, particularly impacting 18 to 24-year-olds, which basically it says you can't pay them dividends, or you can, but it would be subject to TFSA unless they've worked more than 20 hours in the business per month, per week, I should say. So substantial obligation as far as doing income splitting with people who are 19 to 24. 25 to and up, you can do it. It is subject to a reasonableness clause. There's basically an exemption there. Let me just get some more information. It's called reasonable returns, and this exception can apply to any family member who's 25 or older. A reasonable amount of income or dividends can be paid to a family member that represents a reasonable return on their contribution to the business. Examples could be work performed, property contributed, etc. So you can do income splitting through the use of dividends for 25 and up. It is now subject to the same reasonableness test as the salary was. It's also an era where it's probably going to be going through some increased scrutiny because it's new. So generally speaking, we lean more towards salary. It is a little bit more tried and trusted. It's less likely to be going through any scrutiny because there haven't been any changes to it. But if you do want to do income splitting with 25 years and older, you can, as long as there's a reasonableness assessment. Now, in addition, there's another exception that basically says once you turn 65, you can then again do income splitting with your spouse without having to have any reasonableness requirements. So it's not how old your spouse is, it is how old you are. So again, if you're in that scenario, talk to your account manager. We can figure out whether it makes sense for you. Now we want to walk through one specific example of income splitting through the use of salary to give you an idea of the types of benefits that you can achieve via income splitting. So as I mentioned earlier, there's about a $4,000 savings by splitting $100K between two people rather than amongst one individual. So if one individual took $100,000 in salary, they would have about $29,659 in total payable to the Receiver General, including the income tax and the CPP employee and employer portion. We're making the assumption that there's no EI here. So in that situation, you'd be netting out of that 100 grand, some sort of error in my calculation here. I guess that's not including the employer portion. About 73,000. The combined benefit here, if you went with a split between two individuals, would be over $4,000, because you'd only be paying about $25,000 on those two individuals. So this is a substantial benefit, and as you can imagine, the more people that you can income split with, you add in children or grandparents or other family members that we can justify a reasonable salary to, the more money that we can get out. Now, that first basic exemption amount up to about $12,000 is where we're getting the largest benefit. But of course, the higher your income tax bracket, the more substantial this benefit would be. As you can imagine, if I took the $220,000 highest income tax bracket and split that up amongst $4,000, you'd be into the tens of thousands of dollars of savings. So you can imagine lots and lots of benefits of income splitting, but you have to be cautious around income splitting to make sure that it's being done effectively and that you've dotted your I's and crossed your T's, particularly in this new era of TFSA, tax on split income, where the government is going to be coming down on people who are using dividends and income sprinkling through maybe more traditional means. So lastly, and the real reason that we came here is looking at the, sorry, did I? No, my apologies. Yeah, lastly, we're looking at where to actually save money inside your corp. Or sorry, where to save money as far as investments are concerned. So I want to talk to you about the different types of investment vehicles, what they are, and what the pros and cons of each are. Because obviously each of you are going to have a different scenario, and there might be pros and cons to each of these. So let's start with the big one that most of you are thinking about right now, which is your RRSPs. So an RRSP reduces your taxable income. So any dollar that you contribute to your RRSP is a dollar that you're going to not pay tax on. So you can imagine if you had $100,000 of income, you contributed $20,000 of RRSPs, then effectively you're only paying tax on $80,000. Now, what that is it's a bit misleading. It reduces your taxable income today, but when you take the money out of your RRSP, you will be taxed on it. So it's not by definition a tax savings, it is by definition a tax deferral. You're deferring paying the tax from today until the date that you take the money out of your RRSP. And from our perspective, taxes deferred is money saved, because money has a time value, which means if we don't have to pay taxes today, there is a financial benefit of doing that. However, the one thing that we do want to keep in mind is that it is very important to make sure that we're contributing to RRSPs at least the same tax bracket that we plan to withdraw the money out of the RRSPs, because there is a potential tax disincentive of contributing to an RRSP. You can imagine if you contributed to the RRSPs at the absolute lowest tax bracket, but then withdrew in a middle or higher tax bracket, you would actually be increasing your total tax liability. You might be deferring it, but you'd be increasing it. So that's why the goal of an RRSP is to contribute at a higher tax bracket, the higher the better, and withdraw at a lower tax bracket. If you do that, not only do you get a tax deferral, but you also get a tax savings. So for those of you who are not familiar with how much room that you will have, this is based on your salary. It is 18% of your salary or your pre-tax earned income, or $26,500, whichever is less. So the most it could be is $26,500, or if 18% of your income is less than that, it would be less. Now, this is a cumulative number, meaning that if you've been earning income and never contributing, you would have a cumulative balance. That balance does appear on your personal tax return. You should be able to find it if you're not aware of what that balance is. As a small business owner, one of the things that you may want to consider if you have large RRSP room is potentially moving money out of your out of your corporation into your RRSPs. And we'll talk a little bit more about the pros and cons of doing that as we get into the corporation as a potential investment vehicle. The one thing I do want to caution people about when it comes to RRSPs is how the investment income is taxed. As we mentioned with RRSPs, when you take money out of an RRSP, you will pay tax based on your marginal tax rate. That means that while you're earning dividends, capital gains, interest, anything like that, it just increases the amount of money that's in your RRSP that you can later withdraw and pay tax based on your marginal tax rate. So it's not taxed while you're earning the income, it's only taxed when you withdraw it. Now that does have some implications because when you look at things like capital gains and the way that they're taxed, either inside a corporation or in an unregistered account, you will see that it's potentially more favorable to have investments that are going to have high capital gains in other investment vehicles. So let's look at some of the other investment vehicles. The tax-free savings account. Now, the tax-free savings account is almost the polar opposite of the tax-free saving of the RRSP. It does not reduce the taxable income. So when you contribute to the TFSA, you're not getting any reduction in your personal tax rate at all. However, the tax-free savings account is completely tax-free. So when you take money out of the tax-free savings account, you will not pay any tax on it. Now that means you're not paying any tax on any of the gains whatsoever. And of course, you're not paying any additional tax on anything that you had contributed. Obviously, in order to contribute to the TFSA, you must have income that has already been taxed in order to contribute. In addition, one of the great things about a TFSA is that if you need to withdraw money out of your TFSA for whatever reason, you will actually, let's say that we're sitting here right now and you've invested the total maximum, which is $69,500, and you need to take out $30,000 to do a roof repair, whatever the case might be. Well, next year, you could put that $30,000 back. You would get that room back. You do have to wait a full year, and plus you'll get whatever the next year's rate would be, which we're going to assume is probably going to be for 2020, $6,000, and for 2021, probably $6,000. We're assuming at this point again. Now, for those of you who want to know how much you can contribute to your TFSA, we've got the schedule here of all the different years. It came into being in 2009, and you must be at least 18 years of age in any one of these years to get that RRSP or that TFSA limit. So if you have children that became 18, let's say in 2017, then they would have $5,500 for 17 and 18, and $6,000 for 2020, which would give them about $23,000 of available tax-free savings room. So that's how you calculate your tax-free savings account balance. Now this is, like I say, a great emergency reserve fund because you can pull the money out anytime that you need it and be able to get that contribution back. I do also like it because you are literally paying no tax on the gains whatsoever. Oftentimes I find a lot of our clients who have not made use of the tax-free savings account, who are sitting on hundreds of thousands, sometimes millions of dollars of equity in real estate. And one of the things I often look at is how they could potentially leverage that to be able to borrow against that in a home equity line of credit where they might pay 3 to 3.5% interest rate. And then you could literally go and buy even a bond fund, highly safe, highly secure bond fund, and get 4%. So you're going to make positive cash flow, plus the income isn't going to be taxable in any way, shape, or form. So lots of things, lots of benefits about a tax-free savings account, but literally the polar opposite of an RRSP. Generally speaking, when people ask me, should I be doing a tax-free savings account or should I be doing an RRSP? The simple, without knowing anything answer is you should be doing both. If you can't be doing both, then we want to look at probably building up a basic TFSA first. And then depending upon your income tax bracket levels, we want to do an RRSP. Now, if you were an employee making $220,000, of course, that's going to be, I'm going to give you completely different advice. Everything goes into the RRSP at that point because you want to get yourself into a lower tax bracket. Now let's talk a little bit about RESP. Now this isn't saving for your retirement, obviously, but is still an important investment vehicle and should be considered when we're looking at our overall planning, because you want to be able to make sure that you can contribute to an RRSP. Now an RESP again does not reduce taxable income. And in fact, any gains that you have will become income to the beneficiary, which is typically your child, when they do withdraw the funds. In addition, the big benefit of an RRSP is that it's eligible for the Canada Education Savings Grant, up to a maximum CESG of $7,200. So that means you can get up to $7,200 from the government completely free of charge. There are some, I encourage people to look at the definition of the Canadian Savings Grant, how it's calculated, but basically it's 20% of up to $2,500 for up to $500 per year. If you haven't contributed in the past, then your room carries forward. You get it for each year your child is alive up until they're 18. The big thing with the CESG, the Canada Education Savings Grant, is that if your child doesn't go to post-secondary school, then you have to pay back the CESG. You have to pay back any grant that you receive if your child doesn't go to post-secondary. But if if you are planning to send your child to post-secondary, then this is really an essential tool for savings. And again, the growth, although it will be taxed in the student's hands, the benefit is that they typically are going to have a whole bunch of education tax credits and probably low to no income. So it's going to be very tax efficient for these gains to be going to them as opposed to you or your corporation or your RRSP or any other vehicle. Something very similar to the RESP is the RDSP. The RDSP is the Registered Disability Savings Plan. Again, it doesn't reduce your taxable income. And the key here is that you must be approved for the disability tax credit in order to be eligible for an RDSP. Now, you can make contributions for an RDSP all the way up until the beneficiary turns 59, so substantially later than an RESP. So that's one of the big things. It is eligible for something like the CESG. It's just called the CDSG, which is the Canada Disability Savings Grant. And this grant is anywhere from $1,000 to $3,500 per year based on your income tax bracket. If you're over $90-something thousand, you're basically limited to only about $1,000, and you have to make a $1,000 contribution in order to get that. Again, you can look at the Canada Disability Savings Grant details to get exactly how that contributes. Again, my perspective here is if you do have a partner or a child with a disability, that this is something you should certainly make use of, just like you should make use of the RESPs, because this is a way to get free grant money from the government. Now, the other important thing I do want to mention about the RDSP and the Canada Disability Tax Credit is that there are a lot of disabilities that people may not be aware of that are covered. So you might be able to be a working disabled individual with something like Crohn's disease or irritable bowel syndrome or lots of other disabilities that don't prevent you from being able to work, but would qualify for a disability tax credit. So I encourage people to look into that and find out whether themselves, their partner, or their children may qualify for a disability tax credit. And again, you do need to work with a doctor to get certified on that. Next, we want to look at saving money inside of a corporation. Now, the advantage of saving money inside of your corporation, if you're a small business owner, is that you're not going to withdraw this money and it's not going to become income to you personally. So now you're only looking at the small business tax rate. Now, I've pulled up the 2019 corporate tax rates again here, giving you the Ontario and the federal. Now, you'd be eligible as a CCPC for the small business tax rate, which is 12.5%, the 9 federal and the 3.5 provincial, up to a limit of about $500,000. Now, you can see investment income is a substantially higher tax rate than the small business income. So that is one thing to be aware of, is that passive income is not eligible for the small business tax rate. We always have some tricks up our sleeves as accountants on things that we can do. We look at holding companies as strategies to reduce the investment income inside of corporations. So basically what we do in that scenario is, if you have large amounts of investment income, we set up a holding company. Inside that holding company, you draw your salary to bring that investment income down to zero. You're now not drawing your salary from your small business, or what we call an operating company. So that company has more net income, pays higher tax, but is paying higher tax at a lower tax rate. So those are some of the tricks that we have up our sleeves when it comes to tax planning and maneuvers. And again, we want to plan for that. Now, one of the other important things to know and understand, if you do happen to have investments inside of your operating company, which is not uncommon, is that it is now subject to the new passive income rules. Basically, the government, again, didn't like some of the advantages that small businesses had of being able to keep money inside their corporation, not have to take that out, and be able to invest that inside your corporation pre-tax. And anyone who understands compound interest and compound growth, if you can invest a larger number to start with, it will grow faster than a smaller number, i.e. a number that's been taxed. You've had to pay tax, you have less to start with to invest. It would grow slower than if you were able to invest it pre-tax. So one of the rules that they came up with is, they said, basically, if you have more than $50,000 of passive income inside your corporation, we're going to reduce your small business deduction limit. Basically, there's a multiple of 5. For every dollar over $50,000, they multiply that by 5 and reduce your small business tax rate by that number. So if you had $150,000 of passive income, you would end up with $100,000 over the threshold. That multiplied by 5 would be $500,000, and now you would have no small business tax limit, and you would have to pay tax at the full general tax rate of 26.5% instead of the 12.5%. So a substantial increase in the amount of tax that you would have to pay in that scenario. Again, we have strategies and tools to eliminate and combat that, but we need to plan for it. We need to know and understand that there's going to be changes. You're planning to have a year with a massive capital gain, for example, which would be considered passive income. How are we going to plan and strategize for that to be able to minimize the amount of taxes that you're going to pay? This is an essential and crucial part of how we strategize for your overall planning. Now, the last strategy that is available to you, and we'll open this up for questions in just a minute, is an unregistered investment account. Now, an unregistered investment account is held personally. It's not an RRSP, it's not a TFSA, it's not an RESP and RDSP, which are all registered plans, which means that any income that you receive inside this investment is subject to your personal or marginal tax rate. So again, we've broken down here the personal tax rates with just the capital gains and the dividend rates. So again, if you were receiving dividends in a unregistered investment account, it's most likely going to be from an eligible business, a business that's not getting the small business tax rate. So you'll get a better tax rate on those dividends there and the capital gains. The one thing I want to point out is the only situation where this is potentially better is if you had something that was high capital gain, and you didn't have a small business in which you could have invested this in, then putting it in an unregistered investment might actually be potentially better than a tax-free or than an RRSP, because the RRSP, let's say that you had capital gain of $220,000, you would pay tax at 53.5%, because you'd be taking, assuming you were taking that money out of $220,000. If you were in that bracket, you'd be paying tax at that highest tax bracket. Whereas if you did it personally, you only pay capital gains on effectively half, which is 26.5 or 26.76%. Now it's a lot more complicated than these simple examples that I'm giving you, and that's why I love that quote by Albert Einstein. But the key here is trying to optimize and plan as best we can. We never have a crystal ball. We don't know exactly what is going to happen in the future. But the better that we can become at predicting what's going to happen in the future, the more effective our tax planning and tax strategizing can be. So the ultimate question that probably most of you are sitting there with going, well, what does this mean? How much should I contribute to my RRSP this year? And I would say if you're just looking at your RRSP as a strategy to reduce your taxable income, you're going to want to base that around these different tax brackets, and to try and get yourself below the $95,000 threshold or below the $47,000 threshold as targets if you can. Now, RRSP can be used as an effective tax strategy that way. The only other thing you might want to consider is if you have a large amount of RRSP room, you might want to take that out of and you've got a large amount of assets in your corporation. One of the things that you could do is take that out of your corporation, put it into your RRSPs. Your personal income is going to go up by the amount of money that you take out, but it's going to be offset by the RRSP contribution and effectively deferring that. Now, depending upon what your investment strategy and focus is, that may or may not make sense, right? So you've got to look at what your overall goal is. And I would say that you really should be working with a financial advisor if you don't already have one. If you're looking for one, we are going to be doing some sessions on financial planning with Bob Novoselak, who's my personal financial coach, and has worked with a lot of our clients over the years. So we'll be bringing that up. Now I'm gonna open this up to a little bit of Q&A. If anyone does have any other questions, please feel free to reach out and connect with. If you're new to our company, book a free consultation with Rachel. If you are a client, reach out and talk with your account manager. We'd be happy to see what we can do to help you optimize your tax planning. And I'm just going to bounce over here for a second. Let me stop the sharing and see if there's any questions. Okay, so we don't seem to have any questions yet, which means everyone completely understands this, which I find that hard to believe, or you're struggling with understanding where to even begin. So I'll leave it up for a few more minutes for anyone who wants to ask any questions. Maybe I'll even we do have a hand raise. Kamal, let me see if I can allow you to chat. Give me 1 second here. I have to promote you to panelist to allow you to chat, apparently. And that didn't work.
Oh, that worked.
Oh, yeah, it did.
All right.
So,
thanks, Andrew. So first of all,
you have a question?
I want to say thank you for I spent so much time.
We got a question coming on the Q&A. Great presentation. Thank you, Mary. I'm glad you enjoyed it. If I contribute a large sum of RSP in a year, can it be deferred into future years? Yes. So if you made a large RSP contribution, you're not obligated to make use of that RRSP contribution in the year in which you make that contribution. So what we'll do is, it should be up hopefully pretty soon. Jose is recording this. He'll put it up. We'll put it up on our Facebook site, and I'll see if I can get Rachel to send a copy of the recording and the slide deck to all of our attendees. And I do apologize to everyone for the previous week, the hiccups that we had.
Andrew,
Any other questions?
Can you hear me, Andrew? Andrew, can you hear me? No?
Excellent. Well, it looks like we're going to give you guys back some free time. Okay, someone apparently is talking, but I'm not hearing. I'm going to have to switch off.
It's Kamal. If you don't hear me, it's okay, Andrew.
Sorry, Kamal.
No problem.
Having all sorts of technical difficulties today.
No problem. We can. It's okay. It's okay if you can hear me.
Kamal, you there?
I'm here. I'm not sure if you can hear me.
I can hear you now.
Okay, perfect. I was just gonna say, thank you so much. I spend so much time on these topics on my own time, and I found your presentation like on spot and excellent. So thanks a lot for that. My only question was, I remember with regards to the salary versus dividend. One of my eternal question was, is there a optimum strategy between splitting the income between the two? So a little bit of a salary and a little bit of a dividend, and is there an optimum solution over there? So has there been any changes to dividend calculation in the past 2-3 years, and any significant changes on that front, or is it still the old the old brackets?
Yeah, I mean, obviously the income tax brackets change each year, which would affect everything. But there was, going back, I think it was 3 or 4 years now, they had done an update to the dividend tax credits to create true integration so that there was no benefit. There has been some small changes in tax rates since then. So the integration is off a little bit, but there hasn't been but nothing significant. So fundamentally, the taxes are very, very similar when you take into account the dividend tax credits, the dividend gross up amount. Because when we were looking at the dividend tax rates, it gets a bit misleading when you see that there's potentially a 6% higher tax on dividends in the highest tax bracket. Well, that's not taking into account the fact that, dividends would actually be grossed up. So if you gave a salary of $100,000 or dividend of $100,000, it gets taxed at a higher level than $100,000. I think it would be $118,000, if I'm correct. And then there's a dividend tax credit that you get, which reduces the amount of tax that you pay. So it's very, very complicated, but the purpose of it is to make it the same. Right. So there's not one benefit tax-wise of one or the other. So the only real reason that you might want to combine a dividend and a salary together for one individual is if there was something going on inside your corporation that made it not practical to do one over the other. So for example, let's take a company that has its first year of operations, or let's say it's, I don't know, it doesn't matter what year of operation it is, but the last 3 years it's had no positive taxable income. And so if we had a loss, we couldn't apply it back. The rules on tax losses say that if you have a loss in the current year, you can apply it back up to 3 years if there's taxes that have been paid. Otherwise, it carries forward. So if we had a loss that we couldn't make use of, then paying a salary may not be a good strategy, especially if that salary is creating a loss. So let's say it's got $100,000 of income, $20,000 worth of expenses, and for whatever reason, you want to take $100,000 out of the corporation, which would actually create would actually create a $20,000 loss if you did that. Now you might want to, in that situation, go, okay, you know what? I'm going to take $80,000 of this as salary because I want to build up, my RRSP, my CPP contribution and my RRSP contribution limit. So I'll take $80,000, but instead of taking the full 100 and creating a loss, what I will do is I'll take that other 20 as a dividend, and it comes out of the retained earnings, which is presuming there are retained earnings there to take it out of. So it doesn't reduce the income and create the loss, but you're still getting that money out of the corporation and into your personal hands. So in that situation, there might be a benefit to doing both, because you're trying to maximize getting CPP and RSP room, and there's no ability to take a loss and carry it back.
Got it. No, thanks for that. And I think one thing that I think we spoke a few years ago is I did model the dividend tax, and I modeled the marginal tax, and that
was like a $300 difference, I think, right?
Right. There was a maximum was $300 difference, and and we did the simulation for every $100 bracket. So integration held very good. But now that you mentioned that there's been a difference, maybe it's time for me to update my spreadsheet and let it run over a few days, and see if there is any difference at all. Because I did not know that the marginal, the personal tax brackets change.
Yeah, and they do basically change virtually every year. They don't change by much, but they do. So there will be some differences in your calculation, but not not significant. I'd love to, if you've got that calculation, to run it again, because I actually refer to that calculation you've done in several meetings. I'm like, I know someone who's actually gone through this and checked every possible scenario, and I believe it can do a maximum benefit in any one category in any province of $300, if I'm not
right.
correct.
That was $300, and it's and it's not really worth the paperwork of doing.
Yeah, exactly.
Right. All right. Thank you so much for that.
No problem. Yelena's asking you to share that spreadsheet. That's Kamal. Kamal's a client of ours. Many of our clients, as you know, are IT gurus and geniuses and can build amazing pivots and spreadsheets. It's not mine to share. If Kamal is willing to share it with us, it would be greatly appreciated.
I can share the results, no problem. It's just the model itself. It uses a bunch of open source libraries to run that calculation. One of it actually is sent to a university supercomputer because the calculation is a linear programming model. It's an optimization, right? It's the two scenarios: personal tax versus the dividend. Each of them has implication on the personal side and the business side. It calculates the both tax. It tries to minimize its tax. So I can share the results. Certainly, it's 3 years old. 2 years old.
Yeah, but, maybe just print it as a PDF and send it to us, and we'll post it out to the attendees. That would be greatly appreciated.
Yeah, no problem.
Awesome. If no one else has any questions, we've got literally 3 minutes left, so we're pretty much right on time. I want to thank everyone for dialing in today. I remind you, we've got more upcoming webinars coming up. We've got our next one is going to be with Bob Novoselic, as I mentioned, who's going to be working with us on some financial coaching. Great guy to work with, and I think the plan is to have that before the Feb 28th deadline. So again, we can talk a little bit more about different forms of investment and the different strategies of investing your money. So thanks everyone, and have a great day.